$25 a week. That's all it takes to begin changing your financial future. Not a lottery ticket, not some complicated trading strategy, just consistency and patience. And if you give it time, that $25 can actually grow into $3,000 every single month. In this video, I'm going to walk you and John through exactly how that works. You'll see how three simple compounding engines team up to transform pocket change into a serious income stream. I'll show you real examples and stocks you can use, and we'll even build a portfolio together. In the end, I'll show you how this portfolio could turn a $25 weekly investment into a $1.7 million portfolio that pays over $3,000 in monthly dividend income. Before we get into the mechanics of compounding, it's important to understand what we're actually doing when we invest. Many people imagine investing as a form of gambling, like throwing money at a slot machine and hoping for a jackpot. In reality, it's nothing like that. When you invest in a stock or an ETF, you're buying ownership in real businesses, companies that sell products, serve customers, and earn profits. And when those companies grow and succeed, so does the value of your investment. Now compare that to just parking your money in a savings account. It feels safe, sure, but the growth is tiny. Inflation slowly eats away at the value, so in reality, that money's kind of standing still, if not losing value. Investing is different. It lets your dollars get to work in the economy, growing, expanding, innovating, things that can multiply their value over time. Here's where most people hesitate. They worry they don't have enough to start, or that investing is only for the rich. But the truth is, consistency beats size. Starting with $25 a week is more than enough because time is your real advantage. The earlier you begin, the more powerful the results become because compounding rewards patience above all else. That's why the first step isn't even about the money, it's about your mindset. Once you stop thinking of investing as gambling and start seeing it as ownership, those small steps suddenly feel meaningful. And when you realize the slow, steady gains are just the opening chapter, small gains aren't the end of the story, but the beginning of a much larger compounding effect. Compounding works like a machine. Suppose you put aside $25 each week. After a year, you've saved about $1,300 and maybe earned a few extra dollars in growth. No, it doesn't feel life-changing. Many people stop here thinking it's not worth it. But give it 10 years, that same $25 a week could grow to cover a month's rent. In 20 years, it might cover several months of living costs. By 30 years, it can grow large enough to replace your salary. The difference isn't in how much you put in, it's in how long you let it grow. The longer the money stays invested, the faster it multiplies. Those who stop early never see this effect. Those who stay in, do. With that in mind, let's begin with the first type of compounding: dividend reinvestment. Dividends are one of the simplest but most powerful ways that wealth compounds. A dividend is a cash payout from a company to its shareholders, and while some people treat it like extra spending money, investors who reinvest dividends unlock a much greater effect. Instead of taking the cash, the dividends are used to buy more shares. Those new shares then earn dividends of their own, and the cycle continues. Over time, this is what transforms slow, steady investing into exponential growth. The beauty of dividend reinvestment is that it builds wealth without requiring larger contributions from you. Your $25 a week is the foundation, but every dividend paid out by your portfolio is quietly adding more ownership in the background. Year after year, your share count increases, not just because of the money you invest, but because the companies themselves are funding your growth. This is why dividend reinvestment plans, often called DRIPs, are such a cornerstone for long-term investors. Companies with stable cash flows and reliable dividend policies are perfect for this strategy. For example, Johnson & Johnson has a long history of paying dividends and increasing them consistently. Each reinvested dividend buys more shares in a company that continues to expand. Another example is Procter & Gamble, a consumer staple giant that has rewarded shareholders with steady dividends for decades. Even broad ETFs like SCHD, which focuses on quality dividend-paying companies, are excellent vehicles for reinvestment because the cash flow is consistent and the reinvestment is automatic. The real beauty shows up when reinvestment is combined with dividend growth. Not only are you collecting more shares through reinvestment, but the companies themselves are often increasing the size of their payouts every year. That means your reinvested dividends are buying more shares that each produce even larger dividends in the future. Dividend reinvestment doesn't make headlines, but it multiplies wealth. The stocks best suited for it are those with reliable cash flows, strong histories of paying dividends, and the ability to sustain or grow them over time. When you let your dividends buy more ownership in these kinds of companies, your portfolio becomes a self-funding compounding machine. The next type of compounding is share price compounding. Dividends and reinvestment are powerful on their own, but there's another major driver of wealth: share price appreciation. This simply means the value of the stocks or ETFs you own rises over time as the companies behind them grow. When a business expands, earns more profits, and proves its strength in the market, investors are willing to pay more for its shares. That price increase directly boosts the value of your portfolio. Here's why that matters. While dividends give you cash flow, share price growth builds the foundation underneath it. The stocks you hold not only pay you income, but they also become more valuable with each passing year. This means your wealth is growing in two ways at the same time, and that dual effect is what gives compounding its second engine. Let's look at some real examples. Broadcom has grown into one of the most influential players in the semiconductor and technology space. Its products power devices and networks around the world, and its stock price has reflected that growth, delivering tremendous long-term appreciation, averaging 28.91% every year over the past 10 years. And the Vanguard Total Stock Market ETF is another compounder asset that gives broad exposure to thousands of companies across the U.S. economy, making it one of the simplest ways to ride long-term market appreciation. But appreciation doesn't stop there. Companies like Apple, with the ticker symbol AAPL, with its unmatched record of innovation, and Microsoft, with the ticker symbol MSFT, both with their dominance in technology and cloud computing, all show how businesses can multiply in value over the years. Each of these examples shows the same truth. Strong businesses translate into rising share prices, and rising share prices translate into growing portfolios. Now, imagine combining that with dividend reinvestment. Every dividend you reinvest buys more shares, and those shares are climbing in value year after year. The compounding effect multiplies on itself. Dividends are growing, reinvestments are adding ownership, and share prices are lifting everything higher. It's like climbing a hill that keeps getting steeper in your favor. The higher you go, the faster your pace accelerates. Share price contribution is what transforms steady dividend income into explosive long-term portfolio growth. And just when you think it can't get any stronger, there's a third engine, the one that makes those dividends themselves grow larger every single year. And just a heads up, after the next compounder, I will show you a portfolio of stocks I selected using these compounding techniques. And in the end, I'll show you how this portfolio could turn a $25 weekly investment into a $1.7 million portfolio that pays over $3,000 in monthly dividend income. But first, the third compounder, which is dividend growth compounding. The final type of compounding is dividend growth. This is when companies you invest in don't just pay dividends, they steadily increase them over time. It's like getting a raise every single year without ever having to negotiate it. The shares you already own start paying you more. This is the hidden strength behind dividend investing. You're not just collecting payouts, you're collecting payouts that grow larger every year. Each time a company boosts its dividend, you're buying more shares with those higher payouts, which in turn generate even more dividends. The cycle keeps reinforcing itself, creating a stream of income that rises on its own. Take Inter Parfums, with the ticker symbol IPAR, as an example. Known for its strong presence in the global fragrance and beauty industry, Inter Parfums has built a reputation for consistent growth and commitment to rewarding shareholders through increasing dividends, averaging 20.26% each year. Holding shares in a company like this gives you a growing stream of income that compounds on itself. Or consider Federal Agricultural Mortgage Corporation with the ticker symbol AGM, which has delivered one of the fastest dividend growth rates among financial companies, averaging 25.47% each year. What makes it even more impressive is that alongside rapid dividend growth, it's also produced strong share price gains, allowing investors to benefit on both fronts. This shows how dividend growth can transform portfolios. Beyond these, you'll find giants like PepsiCo, which has raised its dividend for more than 5 decades, and Lowe's, which has blended retail success with aggressive dividend growth. When you bring all 3 of these engines together, dividend reinvestment, dividend growth, and share price appreciation, you unlock a compounding effect that builds on itself from every angle. The dividends you reinvest keep buying more shares. Those shares are paying bigger dividends every year, and at the same time, the value of those shares is climbing higher. Over a decade or two, this triple force works faster than inflation, turning small weekly contributions into cash flow and portfolio growth that can feel truly life-changing. So, using the compounder's knowledge, I've narrowed down 5 stocks for my portfolio. Each one taps into different parts of compounding, and together they cover all 3 engines. SCHD is my stability anchor. It has a 3.73% dividend yield, a 10.77% dividend growth rate, and 8.47% annual price appreciation. That means it hits all 3 compounders: steady income, growing dividends, and long-term appreciation. AGM is the growth powerhouse. It yields 3.06%, but here's the kicker. Its dividend growth rate is 25.47%, and its share price has appreciated 22.96% annually. That's my dividend growth and price appreciation compounder. IPAR, the fragrance and beauty company, offers a 2.76% yield with 20.26% dividend growth and 16.51% price appreciation every year. It's another strong player that covers both dividend growth and appreciation. AVGO, Broadcom, looks modest on yield at just 0.8%, but its dividend growth has been an incredible 31.84% per year, with share price appreciation of 28.91% annually. It's a monster for dividend growth and appreciation. And finally, VTI, the Vanguard Total Stock Market ETF, rounds things out. It yields 1.18% with 6.36% dividend growth and 11.87% annual price appreciation, contributing across all 3 engines while giving broad diversification. The next step is to calculate the portfolio's overall metrics, starting with dividend yield. Since I'm treating these 5 stocks as an equal weight portfolio, the math is straightforward. First, take each stock's dividend yield: SCHD at 3.73%, AGM at 3.06%, IPAR at 2.76%, AVGO at 0.8%, and VTI at 1.18%. Add them all together: 3.73 plus 3.06 plus 2.76 plus 0.8 plus 1.18 equals 11.53. Then divide that total by 5 because there are 5 holdings. That gives us 11.53 divided by 5, which equals 2.306, which rounds to 2.31%. That's how we get the portfolio's average dividend yield. And you can use this same method to calculate dividend growth and share price appreciation as well. For this portfolio, those come out to an average dividend growth rate of 18.94% and an average annual share price appreciation of 17.74%. Now, the numbers on their own are just snapshots. What really matters is what they look like in motion, how these averages play out year after year when you keep contributing. So let's project this portfolio forward and see how those percentages actually turn a small, steady habit into something massive over time. Let's put this into perspective with John, who starts small, just $25 a week. By the end of year 1, he's put in around $1,300, nothing flashy yet. But fast forward to year 10, and that steady habit of contributing just $25 a week will grow into nearly $34,114. By year 20, the portfolio will be valued at $254,575. And then comes the real turning point in the third decade. By year 30, John's portfolio will reach a solid $1.72 million, paying $46,353 in annual dividend income, almost $3,900 every single month. The total value added to John's portfolio accounts for $1.68 million in value created over 30 years, out of which $1.43 million comes from share price appreciation, while another $249,964 comes directly from reinvested dividends. Want to know the fastest way to $2,800 in dividends per month? Click the video on the screen to find out.